Welcome to part 2 of the latest podcast from the Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Well, thank you, Jim. That is a startling story. So, Jim, I had a question for you about an event coming up on September 30th, but I don't want to break your flow if there was something you wanted to share with us about the G20 summit. Or should I go to that point and then we'll unfold the G20 story?
Well, they're actually connected. The September 30th event has to do with the IMF and the Chinese yuan, but that is very much related to what happened at G20. So maybe I'll take a few minutes on G20 and then segue into that September 30th event, and then we'll go from there.
So you're going to introduce us. That's great. So tell us about that event and the G20 in whatever sequence makes sense to you.
So the G20 conference just wrapped up, and again, I think a lot of the listeners know the G20. G stands for group, so it's a group of 20 countries. Although there are actually 24 that get invited, but it's called the group of 20 countries of the G20. They operate at different levels: the head of state, finance minister, central bank, technical staff, so-called Sherpas, and a lot of other things contribute. But this was the leader summit. So this was actually, President Xi of China and Theresa May of the Prime Minister of the UK and Justin Trudeau and President Obama and the rest. So they were all there for about 3 days. And they do this once a year, and it's a rotating presidency. So a different country takes turn every year. Next year is going to be Germany. Last year was Turkey. Well, this year was China. And, of course, so that makes President Xi of China the president of the G20. And the G20, I've said for a long time, is basically the board of directors of the world. This is the group that runs the world, even more powerful than the United Nations, more powerful than the IMF, the World Bank, these other multilateral institutions of various kinds. The G20 is it. They're the most powerful group get-together that exists. And so the fact, of course, the Chinese are very caught up in appearance and ceremony and protocol, so nothing escapes their attention in this regard. And I think a lot of people may know when the president arrived on Air Force One, you've seen it 100 times, they wheel up a big, 2-story staircase, and there's a top door on Air Force One, and the door opens, and the president comes down the staircase and meets whatever dignitaries are waiting for him at the bottom of the steps. The Chinese did not let him do that. There's a back door on Air Force One. It's like a hatch, and it comes down the back, and the stairs are much shorter, much closer to the ground, and it's very kind of unimpressive looking. And they made the president do that. So right away, they're kind of insulting the president, and this is the 21st century equivalent of the Kowtow. The Kowtow is a ceremony when you approach the Chinese emperor. Back in the days of empire, you had to lie like flat on your face and then rise and bow and then crawl on your hands and knees like 20 feet and then lie flat again and rise and bow again. Keep doing that for a long distance until as you approach the emperor. So they didn't make the president Kowtow, but making him come off the back of the plane, so to speak, was a 21st century Kowtow Xi saying to Obama, "I'm the boss." So the summit was 2 days. And again, there was a communique. It was pretty long. It was about, 15 pages or so, lots of points. But when you explore these things, and I do, so, okay, there's the communique, but there are 40 separate working papers that come out of this. There's the tax group. There's the structural reform group. There's the SDR group. There's the climate change group, et cetera, et cetera. And every one of those groups produces its own report. And some of these reports are anywhere from 20 to 100 pages long. So you're literally talking about 1,000 pages of very dense technical material that's coming out of these G20 summits. Now, I haven't read 1,000 pages, but I've read quite a few pages in the particular areas that are of interest to me, which are kind of SDRs, financial risk, and taxation. It's amazing what's there. I would say this is the most significant G20 summit since the Pittsburgh G20 summit in September 2009. There were 3 in a row: Washington, November 2008, London, April 2009, and Pittsburgh, September 2009. Those 3 in a row were the response to the global financial crisis. There have been some significant developments since then, but this is by far the most important G20 summit since September 2009. And a couple of things, just to be specific, John. the leaders announced what's called the Hangzhou Consensus. Hangzhou is the name of the city where this took place. Well, as I said earlier, nothing happens by accident. The word consensus, which is the English translation, that's in the English version, very much by design. Now, go back to 1989. There was an article by a think tank scholar in Washington called the Washington Consensus. The Washington Consensus was also called Bretton Woods II. It was basically the blueprint for running the world after the collapse of the original Bretton Woods. So we all know Bretton Woods broke down in August 71, when Nixon suspended redemptions of dollars for gold. The 70s were a period of chaos. The 1980s were a period of the dollar reasserting itself under Volcker and Reagan. The new king dollar period, the dollar was quite strong. The dollar was an all-time high on certain indices in 1985. So by 1989, fall of the Berlin Wall, end of the Cold War, king dollar, the U.S. looks like a global hegemon. At a time when U.S. power relative to the rest of the world was probably at an all-time high, the scholar came up with what he called the Washington Consensus. It was basically 10 rules of the road, your fiscal reform, floating exchange rates, open capital accounts, et cetera. There was a list of policies and more or less said, hey, this is how Washington wants to run the world, my way or the highway. If you don't play by these rules, don't expect an IMF bailout, don't expect foreign investment, don't expect to participate in free trade deals, et cetera, et cetera. So it was basically Washington dictating to the world. It was called the Washington Consensus. Well, clearly in this century, that has broken down a little bit, and we saw weakening in the global financial crisis, et cetera. And I've been talking quite a bit about the diminution in the role of the U.S. dollar, the rise of the SDR. So a lot of this stuff about U.S. power eroding has been in the air, not just financially, but militarily, and we all know what's going on in the Middle East and Libya and Syria. We don't need to belabor all that. But when I saw the word Hangzhou Consensus, it literally jumped off the page at me, hit me between the eyes, because I said, okay, this is the coming out party. This is now, there is no more Washington Consensus. And it's not even, the fact that it was named after a Chinese city. Now, I understand it's the G20. I understand the U.S. is a signatory. The U.S. isn't going away. The dollar's not disappearing overnight. I'm not saying any of that. What I'm saying is there's been a changing of the guard. And when you have global rules of the road, and it's named after Washington, the capital city of the United States, and suddenly a new set of rules have come out named after a city in China. Hangzhou is not the most important city. I mean, it's not Shanghai or Beijing, but and maybe that's what made it palatable to the U.S. But the Hangzhou Consensus are the new rules of the road for the International Monetary System. I haven't seen anyone report this. I haven't seen anyone pick up on this, but the symbolism is unmistakable. And so, well, what's in this Hangzhou Consensus? Well, one thing, which I also saw for the first time, and now I'm kind of trying to share with the listeners the stuff that you won't hear on CNBC. You won't read this in the New York Times. You won't read this in the Financial Times. This is the stuff that goes kind of right over the reporters' heads. And the people who do get it don't talk about it, right? Christine Lagarde understands this, but she's not going to tell you this. So I'm trying to kind of share this analysis with the listeners. We have these new rules of the road. Now, one of them, they explicitly said that the G20 runs the world. Now, I've been saying that for 5 years, and sometimes you get laughed at. Hey, G20, it's just a conference. Who cares? It's like, no. They outsource to the IMF. They intersect with these other multilateral institutions. They don't have a permanent secretariat. That's what the IMF is for. But they do have all these working groups, and they're coordinating with other agencies, the OECD on taxation, the IMF on the SDRs. But they've got a finger in every pie. But they explicitly say, from a governance point of view, the G20, we, the members of the G20, agree that we run the world. I mean, it didn't say it in so many words, but it kind of did say that. Of course, this is self-appointed, self-perpetuating, unaccountable, non-democratic. You got kings and dictators, communists. I mean, this is not necessarily a nice, warm, fuzzy group, but that was explicit. So again, what was implicit for years has now become explicit. So think of this as two things: a charter for the board of directors of the world, and a new set of rules of the road named after a city in China, announced under the auspices of President Xi, who happened to be the president of the G20. This is like saying he's king of the world. Again, symbolism here is unmistakable. But the third thing, and just to kind of put a finer point on this, Our old friend, the BRICS, were back. Now, the BRICS, of course, an acronym going back to 2000. Jim O'Neill, Goldman Sachs, came up with it as like a marketing device. It's the only marketing device I've ever seen that became a political reality. But, it speaks to the power of branding. But BRICS stands for Brazil, Russia, India, China, South Africa. So 5 emerging markets. South Africa is kind of a rounding error on this, but the 5 of them together, led by China, add up to 22% of global GDP, so not an insignificant, almost a quarter of global GDP, not quite. Now, here's where, and the BRICS, 4 years ago, everyone was talking about BRICS. The BRICS had a reserve fund, they had a development bank, they were building their own internet. It looked like the BRICS were, going to tell the U.S. to shove off. And then suddenly, in 2014, 2015, you didn't hear as much about the BRICS. What you really did hear about was China going the wrong way with the Asia Infrastructure Investment Bank and some other initiatives. And it looked like China was going to run away from the rest of the BRICS. Well, suddenly the BRICS were back, and here's why. The IMF has to reform their quota every 5 years. Quota is just vote. It's just, like I said, they can't speak in English. They got to make up words or at least not plain English. Quota is a vote in the IMF. They have to review it every 5 years. That's in the Articles of Agreement, and they've got to make adjustments. Well, right now, the BRICS, I said, they're 22% of GDP, global GDP, but they're only 14.9% of the IMF quota. So clearly, they are underrepresented. Now, the Hangzhou Consensus, this final communique of the G20, says, we acknowledge that the IMF is going to review the quota in 2017, which they have to, and we acknowledge and expect and are in accord, whatever the diplomatic language was, that the percentage quota of emerging markets will increase. Okay, well, if you're at 14.9 and the Hangzhou Consensus says you're going to increase, and that's going to happen in 2017, all of that's laid out, well, obviously, you got to be at least 15%. My guess is it'll be a lot more than that, but you can't increase from 14.9 without hitting 15. Well, 15 is a very significant number because that's the percentage vote that you need to veto an important action by the IMF. In other words, the big deal things need 85% or more to pass. It's a supermajority. You need 85% to issue SDRs. You need 85% to amend the Articles of Agreement. If one country has 15%, they can therefore block it because you can't get 85 if the guy with 15 is holding out. There's only one country in the world that has 15% or more right now, and that's the United States. So the U.S. has always had this veto power. No single country has that. But the BRICS suddenly acting together, holding hands, and they actually do hold hands in the group pictures, they're going to have 15% by this time next year, and that's in the G20 final communique, which means they can block. Now, it doesn't mean you can make stuff happen, but you can prevent stuff from happening. So now just kind of play out the scenario. So next year, the IMF does the quota review, which they have to do. You get a bump in emerging markets representation, which they agreed to. The BRICS have 14.9, which means you're going to blow past 15. That gives you veto power. Now, the world is in a financial panic. There's a liquidity crisis, worse than 2008, and you can see that coming a mile away. The central banks are stretched because they never normalized the balance sheet after the last crisis. The only clean balance sheet in the world is the IMF. The only way you're going to reliquify the system is by issuing SDRs, and you got to have a vote. Well, now the BRICS can sit there and say, we're not voting for the SDRs. We're going to use our veto power unless we get what we want. And what they want is the diminution of the role of the dollar. Like, no more pricing oil in dollars, no more, dollar being the dominant reserve currency, et cetera, whatever their wish list is. So the BRICS can turn to the IMF and say, if you want our votes on the SDR to save the world, because at this point the world will literally be burning down metaphorically, if not legally, or not literally rather, you're going to have to give us what we want. So they will have the leverage to run the dollar off the road by this time next year. It's happening anyway in slow motion, but this would be a very specific tool, a very specific percentage, and a very definite event that you can see coming where all these things would fall into place. I look at Jackson Hole, Yellen's clueless, and this professor has just said that my cash isn't worth par value anymore. And I look at G20, and they said, we got new rules of the road, rules of the game. It's called the Hangzhou Consensus, no more Washington Consensus. And we're going to operate through the BRICS having veto power. And by the way, we run the show. And there was also language in there about SDR. So these are hugely significant events, back to back. Just share with the listeners the stuff that you won't read. By the way, I like all these outlets and reporters. I'm not dinging anybody, but you won't read this stuff on Bloomberg or the Wall Street Journal or the FT because it's way, way down in the weeds. But this was the significance to me, John. So you're right, a very, very eventful past several weeks.
Well, thanks, Jim. That's another rich transfer of information for us. And I'd like to turn the conversation over to you, Alex. And I know that you have some great questions from our listeners. But first, there is another topic that Jim has been writing about recently, what he's calling the beginnings of a war on gold. We've heard about the war on cash. Jim has been starting to warn us about a potential war on gold. This is such an important question, Alex. I really think we should give it priority today. So perhaps from your perspective, you could give us a brief update on the gold market and tell us how this concept of a war on gold resonates with your own experience there on the front lines. And then let's hear from Jim on this.
Okay, sure. So from my perspective, dealing in the gold industry, we've kind of seen this happening over a period of years. And when I say over a period of years, it's been slowly happening for almost a decade now. Our team differs from other gold funds in that our team comes from the physical side of the industry, meaning dealing with refineries, dealing with secure logistics, moving gold around the world, vaulting, etc. And over the last few decades, we've had access across multiple jurisdictions and on 3 continents. So it's given us kind of a view into the changes in regards to regulations impacting investors sort of on a global scale. And we've observed over the last decade or so changes in banking and regulatory requirements which are pointing to the direction of full transparency and full regulation of individual wealth. And without diving too deeply into all of these details, here's kind of a brief list. 2010, the Foreign Accounting Tax Compliance Act was passed in the United States, signed into law. This is also known as FATCA. Some of you might recognize that acronym. Essentially what FATCA is it requires foreign financial intermediaries and foreign financial organizations such as banks, funds, anything having to do with finance and investing to comply with this law globally. In 2012, the U.S., France, Germany, Italy, Spain, UK, they all made a joint announcement that they were going to be implementing FATCA. They were all agreeing to do that. In 2013, Viamet, which is now Loomis, is one of the largest private vaulting custodians in the world, announced that it would no longer allow U.S. persons to have individual accounts or store valuables with them, and they were specifically citing U.S. tax liability issues. In 2014, there was a report that was issued. It was a staff report issued to Congress by the Committee on Oversight and Government Reform for the U.S. House of Representatives. And they identified this program that was a federal executive administrative program that was forcing banks to close accounts of businesses across a wide range of industries. And they came out and they created this list of what they considered high-risk merchants. And these types of industries included things like ammunition sales, coin dealers, credit repair services, firearms sales, money transfer networks, payday loans, pharmaceutical sales, surveillance equipment, telemarketing, tobacco sales. Now, these are all legitimate and lawful businesses in these industries, but they were many of these businesses were notified really without any advance warning that their banks were closing their bank accounts, and few, if any, banks will open new accounts for businesses in this area. It's become very difficult, and this is not just happening domestically. This is happening globally. We've seen this, in a number of jurisdictions. So while this doesn't bear directly on investors, it does show sort of the extent to which governments are going to control the flow of finance, really regarding anything, including industries that it doesn't approve of. So with that in mind, Jim, I know that you have recently talked a little bit about a coming war on gold. Would you like to elaborate on that a little bit more?
That's a great summary, Alex. The only thing I would add is, and it just strikes me as funny, or curious at least, that the war on cash is going full steam ahead. We talked a lot about that. But gold is actually something that U.S. citizens around the world can transact fairly freely. And now you're right, Swiss banks don't want U.S. accounts, so that's clear. But U.S. citizens can go buy gold. I mean, you need a reputable dealer. You got to be careful. I mean, some of the markups are too high. A proper markup is somewhere between maybe 1% up to 4%. That's a little steep, but that's a normal markup. Some of these markups, unfortunately, are 20%, and I feel that people interested in gold get kind of ripped off or taken advantage of by some of those dealers. So avoid the 20% guys. Look for the guys who are less than 5%. A dealer deserves a commission, so I don't mind paying a markup if I buy gold. But U.S. citizens can buy it freely. Foreign citizens, likewise. Foreign citizens can use Swiss vaults. U.S. citizens are going to have to find U.S. vaults, etc. But the government hasn't really sort of done anything. It's funny. I think the government spent so many decades telling you that gold is not money that they started to believe it themselves. And so, of course, I think gold is money. I think it's the best form of money, and I think every investor should have about 10% of their assets allocated to physical gold. But my point being, the government's going to win the war on cash. It won't be pretty, but they've almost won it already. And sooner than later, you're not going to have cash. You're not going to be able to get cash. But for now, you can get gold. But I think once the war on cash is over, maybe a year or two from now, maybe less, when you actually don't have cash, you're not going to have it. You'll have to use, debit cards or prepaid cards or whatever. The government's going to wake up and say, wait a second, we won the war on cash, but how come all these people are buying gold? Because obviously that's a way to get around negative interest rates. That's the way to avoid the government stealing your money. So we need to do to gold what we just did to cash, and we need to make that hard to get. We need to clamp down on dealers, and we need to, increase reporting and just do a whole bunch of stuff that has been around forever in the cash world. So right now the government's got their hands full attacking cash. They're ignoring gold. So in my view, it's a good opportunity to get gold kind of relatively hassle-free, because if you wait, a year or 2 years from now, you might find that, you'll be treated like a drug dealer for buying gold. I mean, it's ridiculous. I don't know why honest citizens can't have any kind of money they want, whether it's a bank deposit, physical notes, physical gold, derivatives, take your pick. I don't know why people can't express a preference for various forms of money, but the government is going to stamp these out one by one. And so there are lots of reasons to get gold today, including the fact that when you really want it, there will be actual physical shortages. We've spoken about that before, independent of government action. You just might not be able to get it, period. But that's one reason. The other thing is the price might run away from you. But a third reason is that the government might decide that they don't want to let you do it. And so I would always make your preparations when the sun is shining. Don't wait for a rainy day.
Very much agree with that sentiment. In fact, we've been recommending that type of thing to people for many years now. So there's a couple of, I say a couple, we've got about a dozen really good questions here in the queue, but I think we've only got time to get to a few of them. We've got about 8 minutes left. The first one is coming from Manuel D. Actually, several people are asking this exact same question or something similar, some rendition of it. Juha M is also asking this question. I'm going to read Juha's question because Manuel D's question is very similar, but he's saying, I'm sorry this is a bit long, haven't found the answer anywhere else. There's been a lot of talk about central banks buying a lot of stocks. So the Bank of Japan, Swiss National Bank, others. My question is it possible that central banks can prevent market crashes by just printing fiat and buying valuable equities as much as needed? And why does the Swiss National Bank have something like $1 billion in gold stocks?
Well, the answer is yes. If you want to, bid up the price of stocks, you can prop them up. And what is the stock market index? So it's just a formula applied to a bunch of closing prices. If you want to print money and buy stocks, go ahead and do it. Now, that is unbelievably unsound. I think that will cause a loss of confidence in money. No part of the stock market, unless you're a really expert trader. If you're an expert trader and you're looking for rifle shot opportunities on over-under valuation and that sort of thing, I mean, that's one way to tiptoe in. But as an allocation in my portfolio, I mean, I have no publicly traded equities. I have, I have obviously gold, silver, cash, land. I do own stocks, but they're private companies. I invest in startups and like tech startups and venture capital type of situations where I know the people involved. It's contracting, invest in hedge funds. There's a lot of things, rental properties, farmland, lots of things, fine art, lots of things to invest in. But the stock market is a huge bubble, mainly because of central bank intervention. I did an analysis the other day, a couple of weeks ago, where I could see that the yen was going to get a lot stronger. Everyone was expecting BOJ intervention and, QE whatever in Japan, and the yen was going to be weaker. And I said, no, the yen is going to get stronger, a lot stronger, trade through par, or 100 rather, which it did briefly with the dollar. So I saw that, but then I took it a step further. I said, well, if the yen is strong, and the large Japanese corporations get a lot of their earnings from overseas, from outside of Japan, when they take those local currency earnings and translate them back to yen, they're going to have fewer yen because of the strong yen, so that's going to reduce their earnings, so that's going to be bad for Japanese stocks. I was completely wrong. The Japanese stock market went up. And I was like, what did I miss? So what I missed was that the central bank of Japan was buying stocks. In other words, my fundamental analysis didn't matter because the Bank of Japan was just waking up and buying Japanese stocks. They don't care about earnings. They don't care about translation losses, earnings per share from foreign exchange translation, all the things that fundamental analysis analysts look at. They were just bidding them up. So the answer is, yeah, central banks can print money and buy stocks. They can prop up markets, but I wouldn't touch it with a 10-foot pole because it's very non-sustainable, very fragile, subject to collapse, based on confidence, based on psychology. And so it'll fail in the end, but it can succeed in the short run.
Okay, very good. So another question that we've got, this is from Adib. I believe this gentleman is a doctor out of the UK. He's got a handful of good questions here, but I'm going to pick his what I think is the most pertinent one to our discussion today, and that is, what economic effect, if any, can we expect when the Chinese yuan joins the IMF reserve currency status in October? I think what he's saying is, as the SDR gets reweighted with the Chinese yuan as a component, are we looking at any specific economic effect from that?
Well, we are in time. These things play out very slowly, and the elites behind it, they want it to play out slowly because they don't want you to notice. And we already talked earlier in the call about how so much of this is technical. It's kind of hiding in plain sight. You can find all these source papers on their websites, but good luck reading them or understanding them. But so just to be clear, what's going to happen? The SDR right now is the value of an SDR is calculated with reference to 4 currencies. Now, a lot of people think there's like this big basket or pot of hard currencies backing up the SDR. There isn't. There's nothing backing up the SDR. Just another form of fiat currency. IMF prints them and hands them out. There's nothing behind it. But you can take an SDR and exchange it for euros or dollars. I can take dollars and buy euros. Well, I can take SDRs and buy euros or dollars. But it begs the question, what is the exchange rate? And so this basket that we talk about is used to calculate the exchange rate. Right now there are 4 currencies in the basket. It's dollars, sterling, yen, and euros. Effective to close of business September 30th or, wake up October 1st, take your pick. The Chinese yuan will be included in the basket. Now, it doesn't mean your dollar's worth this on October 1st. It does not mean you're going to wake up on October 1st and the dollar will have disappeared. That's not how these things work. But what it does mean is that China is on the bus. In the 60s, there was an expression, are you on the bus or off the bus? Well, so far China has been off the bus, but on October 1st, they're going to be on the bus, meaning they're going to be part of this, probably the most exclusive club in the world because you got 5 members. But what does that mean? Well, what that means is that in the next financial crisis, as I said earlier, when you need to reliquify the world, and central banks can't do it because they never normalize their balance sheet, and they're at an invisible confidence boundary. And another $4 trillion from the Fed, nothing to it? I don't think so. At some point, you're just going to get out of the dollar and out of all these other currencies. So where's the money going to come from? When you have to print money because everybody wants their money back, where's that money going to come from? Well, it's going to come from SDRs, except China would not approve that unless they were on the bus. And so the significance of what happens October 1st is once China's in the club, they would then have a vested interest and community of interest in approving and expanding the use of SDRs, which we're already seeing. I mean, the World Bank, for the first time in, I think, 40 years, issued an SDR bond issue, underwritten by Chinese banks, by the way, in the Chinese market. So we're already seeing private, I mean, by the way, that's not the IMF printing SDRs. That's a separate multilateral institution borrowing in SDRs by issuing bonds denominated in SDRs. And if you want to buy the bonds, you got to pay for them in SDRs. And so the SDR is now being expanded in private use, so-called market use. It's going to be expanded in terms of the composite currencies, including the yuan. It was specifically referred to in the Hangzhou Consensus and the G20 final communique that we talked about earlier. It's not. This is not in the lab anymore. This virus has been released, and that is going to sink the dollar. But it won't happen overnight. It could happen quickly if we have a financial crisis soon, which is possible. But even if that doesn't happen, it will happen over the next several years. And so, but my advice is always, people seem to think, well, it's happening in slow motion. Call me when it happens. No, it's happening. What are you waiting for? I mean, that's my point to listeners, is that if you're waiting, you want to ride the stock market thing or whatever, you're waiting for the day when all this, everything I'm describing happens. It's going to be too late. It's going to happen faster than you think. It's going to happen overnight. You're not going to be able to get gold. The dollar's going to plummet. Now is the time to diversify your portfolio to include physical gold.
Okay. Chris T. has mentioned that, or is asking when the recording will be posted. There's so much material to re-listen to here, so much content. We will be posting the recording on physicalgoldfund.com/podcasts. We will also send out an email to everyone to let everybody know when that's available. We are about out of time, but there are a lot of questions in regards to portfolio allocations to gold, how to buy gold, lots of precious metals types questions. And Jim, would you just like to very briefly talk about your last book, The New Case for Gold? Because I know a lot of these kinds of questions are answered in this book.
Yeah, at the risk of sounding like a book salesman, but I guess I am. I have came out in April, but it's still available in bookstores and obviously Amazon. It's called The New Case for Gold. It has, has history, it has economics, it has analysis, but it also has a very practical side. So how do you buy gold? Where can you call? How would you store it? What's the best way to own gold? What's the recommended allocation? All the kinds of questions that some of the listeners are asking are all in the book. So we don't have time to go through it all on the call, but for those who are interested, just go to Amazon. The New Case for Gold, James Rickards, Rickards, easy to find. And I thank everyone in advance who purchases a copy, but you'll find quite a bit of information there, and also other kind of resources to follow up on. And Alex, I do want to, before we sign off, apologize to the listeners for the bad audio, but I hope that Physical Gold Fund was able to capture the audio in such a way that when the transcript comes out, it will all be there, even if some of the audio wasn't as clear as we might have liked.
Yep, we've been recording, and we should be able to post that up so people can listen to it several times if necessary in order to get the material, and we will be posting transcripts as well. So with that said, thank you, Jim, for your time. It's been an excellent discussion. Appreciate your points about the war on cash, the war on gold, and SDRs. With that, going to turn it back over to John.
Well, thanks, Alex, and I'm glad we at least got to a couple of those great questions from our listeners. Of course, we'd love to have tackled more of them, but I think it's clear we've been discussing some momentous developments today. So thank you, Jim Rickards, once again. It's always a pleasure and an education having you with us. And most of all, thank you to our listeners for spending time with us today. Let me encourage you to follow Jim on Twitter. His handle is @JamesGRickards. So goodbye for now, and we look forward to joining you again soon. You've been listening to part 2 of the latest podcasts from the Gold Chronicles with Jim Rickards, presented by Physical Gold Fund.